Russia is a country at war, but it is not only fighting on the Ukrainian front. It is also at war on two other major fronts within. The first is the economy. This is not difficult to predict, but the second is a direct indication of Putin's weakness, and this leads us to a tragic move for Putin. Putin now travels with mobile anti-drone systems. This week, Putin was caught on camera traveling with his close protection, carrying what appeared to be a Yolka anti-drone missile that can be fired from the shoulder. But this was far from a show or a demonstration. Ukraine's drone attacks had forced Putin to travel with a mobile defense system escort. In short, the second front was the loss of confidence in the army and defense systems among all Russians, including Putin. So, what connection could there be between the economy, Yolka launchers, and Putin? It is clear that Russia is facing its worst economic crisis in recent times. As the ruble exchange rate hit 79.7, Moscow fell into silence. When news broke that the Trump administration would grant a 10-day final objection period for its new sanctions package, a sharp sell-off began on the stock market. Just 11 minutes after the news, the exchange rate hit the 82 mark. Reuters ran the headline, "Ruble melts 4%. At the same time, a short Victory Day rehearsal video published in other global media sources announced that Putin's close protection had been caught walking around with what appeared to be a Yolka anti-drone missile fired from the shoulder. Russian mid-altitude air defense systems such as Buk M1 or Tor M2 were completely ineffective against low-signature, high-maneuverability, Mavic-based FPVs. This helplessness forced Putin to make this move. Yolka is a specialized kinetic interceptor designed to neutralize enemy unmanned aerial vehicles without the need for explosive warheads. Instead, it uses high-speed collisions to disrupt the structural integrity of its targets. This method is likened to the shoot-and-forget principle of portable air defense systems. The system's compact design and ease of use allow frontline soldiers to deploy it with minimal training, making it a practical tool for dynamic battlefield conditions. The integration of artificial intelligence for target detection and tracking, combined with its extraordinary speed and maneuverability, is said to provide a high success rate in combat. Of course, this would have provided Putin with a low-level defense, but showing weakness would have cost Russia dearly. When Putin's close protection was seen with the Yolka anti-drone launcher, which appears to be shoulder-fired, the country was instantly convinced that it was defenseless on both the currency and air defense fronts. This is because each unit of the Yolka costs $60,000, and every 1% drop in the ruble's value, according to Defense Ministry projections, vaporizes 600 million rubles. While the Ministry of Finance was under pressure to allocate an additional 120 billion rubles to the armament budget before the end of the year, under the heading of emergency appropriations, oil revenues had already shrunk by 9% on a monthly basis in June due to successive attacks on refineries in Rostov, Volgograd, and Tuapse. Ural's crude oil continued to hover around the 63 per barrel mark. As the currency weakened, every ruble spent by the Kremlin on missiles, radar systems, and imported microelectronics in foreign currency was draining the budget at an increasingly higher rate. If the ruble crosses the 85 threshold and remains there, domestic bond demand could collapse, and targeted asset swaps targeting public deposits may be needed to defend maturing OFZ coupons. At this point, the concept of mandatory anti-drone bonds began to be mentioned loudly behind the scenes. In other words, what was being discussed on paper as a security measure was, in practice, a model of domestic borrowing that would lead to direct cuts in payrolls. The fundamental reason why financial technocrats put such a harsh scenario on the table was the absence of any reserve item to replace the petrodollars that the war economy had swallowed in 2 years. This is because oil flows are being sold at a discount due to sanctions reductions, and physical production loss data from pipeline refinery nodes hit by Ukrainian drone swarms can no longer be concealed. The Russian Energy Agency withdrew its latest statistical report for the second time, citing the need for updates. However, Kunas-based Global Comtrade Satellite Infrared Analytics measured the intensity of smoke plumes in the country last month, at 27% lower than in the same period in 2021, providing clear evidence of the decline in production. In such a scenario, the classic recipe to stabilize the ruble would have been a rate hike, but this was not feasible, as it would have further strained the treasury, which is already struggling to fund military expenditures. The Russian central bank could only raise the funding rate by 50 basis points by the end of June. However, exchange rate expectations entered a tragic breakaway psychology. Ruble USD futures moved to 87.5 in the offshore over-the-counter market, while CDS spread widened by 60 points in a week. The collapse felt by citizens in their daily lives was much more direct, as the foreign exchange card limit, mandatory for payments for imported medicines and car parts, was reduced twice in the state-owned Sberbank app. At the same time, a maximum limit of 3 packages was imposed on sugar and sunflower oil shelves in food chains. As Rosstat gave up updating its inflation basket, the official annual rate stood at 8%, while civilian economists' measurements pointed to 18%. The difference at the bottom was now closed by rumours of preventive bond deductions from payrolls. A draft revision prepared by the State Duma Finance Committee would nationalize 3% of citizens' bank account balances in the form of digital financial assets if the ruble falls below 85 for 3 consecutive business days, transferring the funds to the Defense Ministry's procurement fund. In exchange, bonds with a 4% ruble interest rate over 5 years will be issued, effectively creating a mandatory savings scheme with a negative real return, similar to the Soviet-era reward savings certificates. Technical justification: the rapid proliferation of Yolka-like kinetic anti-drone systems, as electronic jamming has failed, and the cheap FPV swarm tactics experienced with Iranian-made Shahed variants have disrupted Russian air defense plans. The doctrine of locking onto targets emitting intense radar signals, as employed by medium-altitude units like the Buk M1 or Tor M2, proved completely ineffective against low-signature, high-maneuverability, Mavic-based FPVs. As a result, the Defense Ministry turned to Yolka missiles, which must be paid for in foreign currency. However, as the ruble collapsed, defense spending ballooned, with 57 billion rubles already spent on anti-drone measures in the first 5 months of the year. The 120 billion ruble supplementary budget requested at the end of July drew criticism even from Parliament. Economists say that with foreign currency borrowing increasing exponentially and Russia being the only country selling at a discount, despite the price of Brent crude, the only option is to expand the tax base or devalue the ruble in a controlled manner and tighten the budget in the domestic cycle. But as the Putin administration enters an election year, it finds it unthinkable to cut military spending. This reinforces the ruble's vulnerability. Indeed, Trump's decision to reduce the objection period from 180 days to 10 days and the clarification that SWIFT restrictions will also cover derivative products has pushed Moscow's financial corridor into a tighter corner than in 2014. Accompanying this, Ukraine's low-cost, high-density drone strategy has set fire to oil storage tanks, ammunition depots, and even the Rostov-Volgograd railway junction. The reconstruction bill is denominated in foreign currency, while the oil you sell is discounted in rubles, creating a double-edged scissors effect. The decline in the central bank's foreign exchange reserves from $320 billion to $213 billion is the liquidity side of this scissors. In addition, 1/3 of the reserves are blocked abroad, and the rest is in yuan and gold, so the coffers are even emptier for imports that require hard currency, such as the Yolka missile. International research groups CSIS and RAND state that as the ruble weakens, relying on expensive kinetic solutions is pushing the Kremlin into an unsustainable spiral in both its balance sheet and supply chain, while burning foreign exchange to cover failures in electronic warfare is accelerating economic deterioration. While heroic epics play out on Russian television, the real crisis is felt in the streets and at the grocery store, where North Caucasus oil workers have not been paid since March. Eurovagonzavod subcontractors have begun paying their advance fees with concrete and iron left in warehouses instead of rubles, and the spot price of steel has risen in ruble terms but fallen in dollar terms, because currency depreciation is driving up raw material costs. The clear picture emerging from this first paragraph is as follows. As the ruble becomes a suspended currency on the foreign exchange front, the image of a bodyguard carrying Yolka on his shoulders in the air is a confession that even cheap FPVs can penetrate the prestige armor of the Commonwealth of Independent States Army. Thus, economic devaluation and security devaluation collided on the same symbolic day, and Russia's war machine is now engaged in a two-front panic struggle, not only on the front lines, but also within its own internal cycle. The fragility of the ruble can no longer be read from daily charts, but from the sparseness of smoke rising from factory chimneys. This is because in the first 24 hours after the exchange rate climbed from 82 to 84, 9 companies linked to the manufacturing index on the Moscow Stock Exchange suspended trading. But even the central bank's move to impose quotas on spot currency demand before the weekend could not slow the meltdown of reserves. This is because export invoices are being settled in a dollar-yuan basket, while import banking still demands convertible foreign currency. Moreover, the Defense Ministry requires a foreign currency deposit to import Israeli-made infrared sensors via a third country for the Yolka line, which adds an extra 600 million rubles to the budget for every 1% depreciation of the ruble. Calculations made at the end of July indicated that the ruble's 17% depreciation, compared to the beginning of the year, would result in an additional 10.2 billion rubles in costs for the anti-drone budget. Moreover, the Armenia-Georgia transit route, which the Kremlin has designated as a critical import corridor, slowed by 38% in February and March transfers due to a swift warning from regional banks, seeking to avoid being added to Washington's secondary sanctions list. Therefore, while the request for an additional 120 billion rubles was being discussed in the Duma, the Treasury was forced to open an OFZ auction worth 950 billion rubles on the domestic debt market. But when forward buyers demanded foreign currency-based swaps instead of trusting the ruble, the yield curve steepened. The 10-year coupon hit 13.2%, the highest level since the 2020 pandemic shock, making it impossible to refinance social spending funds. This is because the budgets for education, health, and pensions total 7 trillion rubles annually, while defense spending has exceeded 11 trillion rubles. This is where the idea of imposing mandatory anti-drone bonds on payrolls came into play. According to the Finance Ministry's draft, if the exchange rate remains above 85 for 3 business days, 3% of all employees' net income will be deducted and converted into 5-year bonds that cannot be redeemed early and are not indexed to inflation. The central bank will record this item on its balance sheet as a mandatory social participation instrument. The real return will certainly be negative, but the bureaucracy hopes that it can be sold as a direct contribution to national defense. To make up the difference, Moscow is covering the freight insurance for India, but premiums have risen 40% due to the currency shock. As a result, the income statement is melting away, with the budget deficit reaching 2.8 trillion rubles in the first half of the year, compared to a target of 3.2 trillion rubles for the year. In other words, the projected deficit was almost filled in the 6th month. On the social front, wages and prices are spiraling upward. The St. Petersburg municipality has raised public transportation fares for the 2nd time this year. Electricity subsidies have been lifted in the Far East. Bread producers in the Kurgan region are begging for flour coupons. The tax office is demanding advance VAT payments. Physical cash shortages have begun. Airport currency exchange offices in Siberia have hung signs saying they have no dollars. This is because the central bank is keeping cash transfers to regional branches under pressure. Even transfers of precious metals, which importers call the grey corridor, have been disrupted due to the Black Sea insurance ban imposed by the Korgantech logistics company. While the Kremlin may describe this situation to the public as temporary pressure, there are no traditional tools left to defend the ruble. Raising interest rates would strangle the budget, selling reserves to buy foreign currency would be a mistake under sanctions, and increasing production by bypassing OPEC plus quotas is impossible due to refinery repairs. The only realistic option is to keep the ruble in a position of slow but steady depreciation. But since the war economy has a high share of imported inputs, this gradual devaluation is multiplying input inflation. As the vicious cycle spins full circle, the expensive kinetic panic symbolized by Yolka orders is creating even higher foreign exchange needs. Therefore, the ruble is falling, import bills are growing, the budget deficit is widening, and the ruble is falling again. International investment banks' Moscow desks are no longer providing exchange rate forecasts. The risk of a political decision shock is adding to the negative outlook. Fitch changed its rating outlook to negative even before revising the rating. Russia's 2026 maturity Eurobond traded at a 17% yield in mid-July. In other words, the market fears that the government will not be able to find foreign exchange even 3 years from now. Domestically, businesses are opening ruble-yuan swap accounts at Chinese banks and accumulating funds there instead of transferring profits directly. However, since yuan cannot be spent within Russia, investments are fleeing abroad in physical form. This is drying up the capital stock. From a military perspective, the Yolka image is not just about protective aesthetics. It is a declaration of bankruptcy for the army's electronic jamming solutions. This is because the anti-drone jammers produced by KRET at its St. Petersburg factory used lithium cells sourced from Taiwan. Imports were restricted and production declined. The old model jammers with thick walls were heavy on the front lines and had limited range, so they were replaced with expensive, single-shot kinetic interceptors fired from the shoulder. 70% of the supply contract signed for the Yolka stock is denominated in foreign currency, while the ruble has lost 12% since June, and the 600 million ruble/% rule is hitting hard here. While CSIS's latest report uses the term unsustainable loss budget spiral, the RAND scenario predicts that if the ruble reaches 90, the Ministry of Defense will request an additional 250 billion rubles. This is because every item in the supply plan is dependent on imports. The opposite effect is seen on the Ukrainian side. The dollar-based cost of drones remains fixed, while Russian defense purchases in rubles are becoming more expensive. Thus, the low-cost high-loss equation is widening in Kiev's favor. In other words, as the ruble weakens, the price of Yolka rises, and as Yolka orders increase, the pressure for additional budget allocations further undermines currency expectations. On the streets, the people's fundamental question is clear. Will the government save the falling drone or the melting ruble? As traditional tools to curb the exchange rate are being phased out one by one, the tremors that began in the lower echelons of the economy are now reflected in official figures. A 10% decline in non-oil and gas revenues was announced for the July-September period. However, because the average exchange rate in the month in which the tax was collected did not match the import bills immediately following that month, the Ministry of Finance was forced to create a new item in the budget called exchange rate shock compensation. This means that every time the ruble weakens, an additional subsidy is created for the same tax unit, and that subsidy in turn creates a need for foreign currency. Thus, the ruble is depreciating rapidly, not only due to external pressure, but also due to the internal mechanisms of public finance. Moreover, oil revenues are shrinking not in terms of turnover, but in terms of profit. This is because shadow fleet insurance has become more expensive, and the Urals discount has deepened. The re-export corridor through Finnish and Baltic ports has closed. This has dragged down foreign exchange inflows, which are the lifeblood of the war economy. On top of that, FPV fleets supported by Ukroboronprom caused 5 separate fires in storage tanks in Novorossiysk in July and August. Transneft's emergency repair fund has been exceeded by 50%, and the company has for the first time requested an advance directly from the budget instead of bonds. It thus entered into competition with the Ministry of Defense. When both were forced to ask the central bank for rubles, the monetary base swelled. Inflation returned to double digits in October. Rosstat labeled this as energy distribution costs, but market shelves showed that true-type inflation exceeded 30%. To escape this vortex, Putin's administration is looking for new financial partners to whom it can pledge its traditional collateral, namely oil. But Chinese banks are accepting yuan rather than rubles due to concerns about secondary sanctions. The yuan is not fully convertible in the Russian domestic market, so barter and clearing proposals are on the table, but none of these can pay state workers' salaries or index increases for pensioners. Thus, while the economic channel is squeezing Moscow, the security channel is exerting the same pressure. The Ukrainian side, meanwhile, has shifted its target list to defense projects with high foreign currency requirements in order to squeeze the ruble-based defense budget. Drone attacks burned German-licensed machines at the Cosmos electro-optical satellite factory, and foreign currency is needed to bring in new ones, which requires new bonds, which in turn requires the value of the ruble. With each turn of the wheel, the fragility of the economy becomes more visible, and at the same time, the public is experiencing for the first time the reality that the cost of war is coming out of their own pockets. Every day, a 0.3% loss in value. Every night, cheap motorized FPVs, rendering expensive kinetic Yolkas obsolete. Both the treasury and street morale are being consumed simultaneously. As the line between financial collapse and defense deficit blurs, the Kremlin can no longer answer a single question. If the money runs out, what will protect the sky? If the sky falls, who will care about the ruble's value? This question will likely echo loudly in Putin's ears, spreading from the streets of Russia to the inner chambers of the Kremlin. Thank you for watching.